We're going to be a proactive versus reactive firm. So I ended up getting 27 companies under LOI by cold calling them myself.
In this episode of Investors and Operators, I am chatting with Jarrett Turner, who is the founder and managing partner of Soundcore Capital Partners. Soundcore is a buy and build private equity firm making control investments in primarily founder-owned and led companies, really in industrial services, business and outsourced services, specialty manufacturing, and value-added distribution. Soundcore has done over 110, maybe 113 acquisitions across 14 platforms. Recently raised Fund 3, which was oversubscribed at $450 million. And this is going to be a story about not just, Jarrett, your story growing up, but also the founding story of Soundcore. And then we're going to talk about what advice you would give to people who are at Fund 1, Fund 2, your journey and the evolution from Fundless sponsor to where we're at today at Fund 3. So we're going to talk about fundraising lessons, dive into value creation playbook, even get into talk about an annual meeting, and a couple of other topics if we have time. So Jarrett, it is awesome to have you here. Super excited to chat with you. Let's just start with your story growing up.
Absolutely. And thanks again for having me today, Jordan. Well, I think I came from a non-traditional background for a private equity person. I see a lot of people from private equity that had role models in their parents that were in some white collar capacity. Certainly had gone to college, but I come from a background where neither of my parents went to college. It wasn't expected that I would go to college. And my father drove a van or a pickup truck, depending on the year, and had that in the driveway. And I grew up around blue collar services, a lot of end markets that we touch and have touched over the years at Soundcore. So my father, still today at 73 years old, works 7 days a week, doesn't believe in taking off Saturday or Sunday, certainly doesn't watch golf, doesn't have a football team. And he runs a roofing, fire, water, and mold and remediation business, as well as a general construction business, primarily residential focused. And growing up around that, I saw a lot of inefficiencies of a baby boomer. Didn't have the right scheduling, was using whiteboards for things, didn't have the safety programs that maybe you would see at scale businesses, certainly didn't have procurement programs in place for supply, didn't necessarily have go-to-market strategies, didn't have an ERP system to go and figure out daily KPIs. It was a lot of finger in the air, grow my business as quickly as I can to scale that I could. But I learned a lot about blue-collar businesses without thinking about it at the time is something that I would end up doing. So, I come from that.
I think I know the answer to this, but what was your first job?
I think my first job was sweeping up cigarette butts, where you could imagine an addition that was added onto a building, plywood floors, sweeping that up, doing kind of menial tasks, weeding, stuff like that.
So did you kind of feel that you would be an entrepreneur just from an early age, or did you kind of know what you would do?
I think there was an underlying current that my father had started his own business at 19 years old, that maybe I would do something. I had no idea what private equity was. I didn't know anybody in investment banking. I barely came to a city like New York as a child. But I felt an internal inertia that I wanted to do something. And I think that there was an underlying current of seeing inefficiency in sort of a founder, owner operated business that grew to a certain scale and maybe stalled out along the way. I saw a lot of opportunity that I think gave me the impetus to start something someday without really knowing it.
Yeah. When you look back to watching your dad and the business, like what lessons do you think that you got from him that have just really stuck with you throughout your whole life and that apply to not just business, but family and everything else?
Yeah. I mean, I think most important to me is being a good person. Always having the highest level of integrity, never lying. My dad always taught me that doesn't matter, who you are, what profession you're in, that no one can take that away from you. My father remarked on a number of people that, had cheated on their wives or had lied to a business partner. And those are things that, you could see across many different professions. But as long as you had the conviction and the highest level of integrity, ethics, and morals, you would see another day, and you could stand, with your head high. My dad does say when he dies, it's going to say on his gravestone that he lived and he died, nothing more, nothing less. So I think the humbleness and the hardworking, mindset alongside the high integrity, the honesty, the transparency, I think those are things that stuck with me no matter what I ended up doing.
Yeah. What's your gravestone going to say?
Born in 1981. Hopefully, it's going to say that I lived 100 years, and I don't know beyond that. That I love my wife and my daughter, and hopefully, I'll have some more kids to talk about by then.
It's not going to say raised an oversubscribed fund
No,
at
really not.
450. So how did you get from, what's the story growing up to kind of where we're at today?
Yeah, funny enough. So I went to college. I came out and did investment banking. So found a different route than my family, but I didn't know what private equity was still. I was doing mortgage-backed security investment banking. I wasn't doing traditional investment banking of M&A. And I was doing that in 2004 to 2007 during the sort of boom period of mortgage-backed securities. My father was actually putting on a new roof for a placement agent who had just raised a private equity fund, and made the introduction to me. And I had no idea, what that fund was doing, didn't know how those deals were structured, but learned a lot through those conversations. And that was my entry in a non-linear way into private equity in 2007, and I haven't looked back since.
So were you, so your dad was doing the roof of a placement agent, and he knew that you were doing banking at that time for a couple of years, and he just randomly made the introduction.
Yeah, my dad knew he couldn't really help me or give me advice, right? He wasn't
Yeah.
someone that subscribed to the Wall Street Journal. Um,
Yeah.
but this was something that, he thought he could do as a good thing for his son. Maybe this would be an introduction, open a door. And he made that introduction, and that was a really helpful introduction.
So, so the first, role job in private equity was at Clearview, and then at Suncap, and then you decided to start your own firm.
Yeah, so I worked at a private equity firm called Clearview. They had closed on a $250 million fund after they
Yeah.
had been a fundless sponsor for a number of years. Great place to work, and they're doing really well today. One of my fellow associates is now the managing partner of that firm. I moved on from that firm. So that was a 250 fund. 2008, they had closed that. And then I moved on to a firm, Sun Capital, that had closed on a $6 billion fund in 2007. That was their fund five. And that was closely on the heels of a $1.5 billion fund that they had closed a couple of years earlier. And so going from a $250 million fund to a $6 billion global fund was a huge step change for me. And I learned a lot of good things at both places. I learned a lot of things that I wanted to do better or I wanted to do slightly differently. And while I was at Sun Capital in 2011, I was there for 4.5 years. 2011, sort of in the middle of my time there, I formed the idea of Soundcore, and I formed the name out of what my intentions were. So the word sound in the basis of Soundcore was around sound investments. So very healthy businesses that did well no matter what's happening in the economy. Some of the things that I was looking at while at Sun Capital were distressed companies, pre-packed bankruptcies, maybe a furniture company that would go bankrupt by the end of the weekend. You had to make a quick decision on pricing. So those would not necessarily fit what I was looking for. So I took a step back and said, going back to the '08, a few years earlier, to 2012 that we were in, what are the businesses that are doing well right now, right? In 2011, we were kind of coming out of the GFC or starting to see a window out of it. And there were certain businesses at that time that were minting money, high free cash flow, very dependable top line. And I said to myself, those are the types of businesses that I really want to work on. And then when I think about the core, when I created that, the name Soundcore, core to that goes back to really my youth of highest ethics, highest morals, highest level of integrity. No one can take that away from you. It doesn't matter how much money you have, right? So that's really, really core to the principles that we live by at this firm and that I wanted us to live by. But then separate of that were three things that private equity, big and small, got wrong along the way. People overpaid for companies, they overlevered companies, and then they made concentrated bets on what they thought were their winners. Sometimes they got those right, but I've seen a lot of firms where they bet 20% of a fund, got LPAC approval, thought it was a good business, it was doing well for a while, and it took down the entire fund below the carry hurdle. They lost a lot of people, there was a lot of attrition of LPs and employees. So marrying all that together, really healthy companies, don't overlever, don't overconcentrate, don't overpay, always be guided by the highest ethics and morals. That is what I thought of at Sun Capital, creating Soundcore on a white sheet of paper. And then I also said, there's been an evolution of private equity. More and more firms keep getting added to the box of private equity every year. And so there's more, population base of private equity firms. It's not like we're growing our company base at that same clip. And so when I thought about that sort of saturation point, almost all private equity firms were reacting to somebody else's idea or an opportunity that a banker presented to them that maybe fit their website criteria. And I had been working on those both at Clearview and at Sun, finding opportunities that other people presented to us, finding a way to price those and present a price and try to win an auction process. And that's the vast majority of private equity firms globally today. So I said, one thing I'm going to do in terms of buying right, not overpaying, is create a proactive versus reactive private equity firm. And that was essential, core to the Soundcore strategy, is to be a thesis-driven private equity firm versus a reactive, smart, intelligent buyer, be able to price what you can pay, and then try to win the auction process against 200 other private equity firms with the same information.
So how does that kind of lead into the first chapter of getting the business actually started, finding your first deal, finding the capital for that first deal? Like, talk to me about chapter one of the business.
Yeah, I mean, chapter one of the business was a lot of people telling me this is not going to work. Don't even start chapter one. Go to another private equity firm if you don't like that strategy. I was 33 years old. I'm living in a walk-up building in the West Village of New York City. I've got enough money for rent for a couple of years, and that's my total net worth. So it's not like I spun out of a large private equity firm, was sitting on a lot of capital to build out the firm and get office space and have fancy branding and have someone build me a website. So I'm starting off with very little money. I'm making a bet on myself, and I'm making a bet on the thesis that I have of a proactive buyer with those sort of intangibles that I mentioned. I'd say the first 2 weeks, I'm working in a stairwell of a library, making calls because you can't make calls in the library. I've got a row of business cards because this is in 2015. I didn't have a CRM. So I'm literally picking out business cards, emailing different people to announce that I've started Soundcore. I created a one pager, no acquisitions, no team. This is Soundcore. This is our focus. This is what we're going to be buying, but nothing really to look at beyond that. I got Vistaprint business cards, I think, for $30. And then in a couple of weeks after that, Kirkland & Ellis, the law firm, said, you know what, you should be working out of real office. We'll give you free office space for a couple of years, but it's going to be, it's not going to have windows. It's going to be a little bit of a casino. We'll have lights on in there, but you're not going to be able to tell if it's raining or if it's daytime or not. So we worked in an old storage room for 2 years. And at first it was literally just me with these Vistaprint business cards that had my apartment address as a suite address. And I had a website that I created with GoDaddy.com. I created the website initially with Squarespace myself, the best that I could. I don't have a computer programming background of any kind. And, had, the team page, me, the focus, the strategy. The address is now updated to 601 Lexington, Kirkland's address. And that's how I got the firm, infrastructure off the ground. The first, sort of notion of helping me was to go to some of the senior bankers that I knew to see if I could work some of their connections, to get somebody to be a bit of a mentor to me that maybe didn't need to get paid. So I got someone that had worked in private equity for a long time. He kind of gave me a little bit of the Heisman, like, I don't need to get paid. So that's exactly what I was looking for. Someone that had a high net worth that was able to give me some free advice. And they said the number one thing you're going to need to have here if you're going to set up an institution is you need someone to set up and think about payroll, healthcare, all the sort of operating entities that you're going to need to set up and registering for businesses. So I brought in Art Zuckerman, who's still with me today, but at the time he was only part-time because I couldn't afford him full-time. And then as I started to think about what I needed to do next, it was I need to get really high quality companies that fit the mandate that I already discussed of mission critical, high free cash flowing, recession resistant. I got to be proactive about it because I have to have integrity around what I just said. We're going to be a proactive versus reactive firm. So I ended up getting 27 companies under LOI by cold calling them myself, which started our cold.
When was this? Like what month in 2015 or whatever it was, 2014, did you truly really start getting after it and, pound on the pavement?
I mean, that was probably 10 days in to starting the firm.
Yeah.
Because I heard from a number of placement agents, if you want to raise a private equity fund, you're not going to do it at 33 without a track record or attribution. And it's really hard to do it, period. So if you're going to do this and you want to have a chance, you're going to need to do 3 or 4 buy and builds because that's your focus. You're going to need to do those that would look like they would be in a fund, in a composite fund, commingled fund. And you're probably going to have to exit one of those. So this is a 3 to 4 year thing you're going to have to go out and do. And you're going to have to do that where you have performing assets because maybe you have 3 or 2 of them you can't sell yet. They're too early. And then you're going to use that as your resume to go out and raise a fund. So I knew with conviction that I had to go out and do at least 3 of these things. And so, my mission statement was to go out and get that done. And so there was no time like today. And so there were times I slept in that office. There was couch cushions that I slept on. And getting that off the ground, I hired people that were not the long-term fit. Many of them worked for free for 6, 7, or 8 months. I got 3 NYU interns off of an NYU message board. I got over 200 resumes in for that. That was a process just sifting through all those. But, with, I would just say grit and determination without, more than that, I got it off the ground.
Investors and Operators is the podcast of 51 Labs, a full-service digital marketing agency that focuses on private equity firms, the portfolio companies, and others in the M&A market. We handle everything from branding to video to websites, LinkedIn content, and everywhere in between. We've done over 150 projects since 2019, and usually we do a lot of work with emerging managers, so funds 1 through 3, independent sponsors, but also funded private equity firms. Reach out, happy to help out. So 2015 is when you really start the firm. And then what was your first platform? How'd you find the money for it? And what was, what is the time frame for really chapter 1?
Yeah, so early chapter 1, April of 2015. I started the firm in March of 2015. Getting, 3 or 4 or 5 companies under LOI in the wheel repair space, providing those services primarily to car dealerships and auto body shops. About 80% was done on site at the dealership through either a box truck or a trailer attached to a pickup truck, where they're taking the rim off your car because it's scratched or it's dented, and they're doing the repair of that and giving it back to the dealership or the auto body shop that day. The rims where you maybe went through a pothole and cracked your rim, your car to be towed because the wheel had integrity. Those are usually done off-site, and they're put back into an oven and given back within 24 hours. So over April through probably July, got 27 companies at the same time under LOI, which is something I do not recommend to do unless you're maybe a team of 100 people. So I had enough EBITDA to go out and start marketing it. I was fortunate enough in May of 2015 to be a feature article in Buyouts Magazine, a new firm on the block. Like I'd raised $1 billion fund or something, but I'm just a fundless sponsor. But they did that for me at that time. And a number of LPs wanted to have at least initial conversations to hear about the focus area, where I'd come from, what kind of deals are we looking at? And so I was able to actually get 5 different LPs that wanted to give me all 25 million that I was looking for. And at the time, and I would highly recommend this if you're a fundless sponsor watching this, or maybe you're a first time, private equity GP, some of those LPs had consumable terms that you could live by, and some of them were definitely out to get the best of me and the firm and get the best terms. It felt more like almost getting an LP from a hedge fund than a traditional, primary check writing LP. There's a lot of those types of LPs that try to take advantage of fundless sponsors when they can. And I would highly recommend sifting through those. And I'm happy to be a reference for people, on the type of groups that you want to avoid and the type of groups that are good partners.
So it looks like you didn't have to give up an arm or a leg. I see everything intact right now.
Yeah, I mean, there were certainly groups that said, I want, 20 or 30% ownership, permanent ownership of the firm. There's other people that if you made a 9X MOIC, you still couldn't make 20% carry. There's other people that wouldn't let you charge any closing fees because you don't have a fund level management fee. Well, how are you going to pay for a team? It's a mixed bag, but there's everything in between.
Is for the firms that need to go down that route when they do need to give up an arm and or a leg, like does it work out at fund 2 and beyond where it's just like, you know what? Okay. It was really uncomfortable, but it made sense later on down the road. Like, are the trade-offs actually worth it? And you've been around, your peers for a long time. Have you seen, and you have probably enough data points to people who have gone down that route. Like, is it worth it, or just stay a fundless sponsor and have more control?
I think it depends on your individual situation and those individual terms. I think the most important thing to be cognizant of are the permanent ownership pieces, where you have no call option or ability to outperform and get the ownership back. I think there's instances where maybe a fundless sponsor is raising their first formal fund and they need an anchor that are doing sort of a seeding LP stake of anywhere between 75 million to maybe 150 million primary check into the fund. And they either get anywhere between 10 to 15% stake in the business, some that you can buy back over time, or some that sunset based on certain returns over a certain number of funds. I think that's a lot more acceptable for a very large check versus when you're a fundless sponsor to give that up. I think there are a number of LPs that come into those fundless sponsor deals that want co-investment rights at no fee, no carry. They may want those as part of their check into that fundless sponsor deal. But a lot of times what they'll do is they'll say they want that across a couple of deals to create a kind of a commingled structure to it, to prevent you to raise a primary fund for a certain number of deals so they can get those terms for a few years. But then they'll want to get those co-investment rights likely into the primary fund. So be wary of that. There's some that will come into these fundless sponsor deals that will say, no, we want you to do a fourth deal and we'll prevent you from raising your commingled fund. Those are things that you could miss when you're desperate for capital early on. And I would say try to pan out and have some perspective, and don't just grab at those things. Try to think long term, where you want your business to be 5 and 10 years, what you might regret, and try to find other ways to solve the problem or bridge your problem.
I love it. So then that's chapter 1. What's the next chapter?
So as soon as we closed, I would say the dance was keeping all these companies under LOI, extending the exclusivity with the business owners, explaining to them why you haven't closed yet. That was a bit of a ballet. Getting the money teed up, negotiating that with the group that was coming in to back the wheel repair deal. That closed in November of 2015, celebrated, with some champagne that someone's mother sent us. That was a great moment. I would say at that point in time, it was one of the best days of my life, right? Got the first chess piece on the board, really excited, closed a few more deals by the end of the year. I felt like I was really in business. Then, with that excitement sort of dying down after a few days, it was like, all right, well, now we got to do the second one. The idea here was not just to do one, not to be a one-hit wonder. We want to do 3 or 4 of these. So there's, again, no time like today. Let's get going on the next one. So developed a thesis in either December of 2015 or January or February 2016 around mission critical pump repair. So think of a building, an office building I'm in now. I'm on the 20th floor. There's a few $1 million of pump equipment that push water up. There's grinder pumps and wastewater pumps. There's pump stations and municipalities to deal with all the city's water. They're absolutely mission critical. They're the type of business that does well with, not affected by AI, unaffected by what's happening in Iran right now or an administration change. So definitely fit the model, high fragmentation in that industry, large market TAM, nationwide, and fragmented through states. It wasn't like only in certain states. So the pump repair thesis was sound. One after the first pump repair business in Los Angeles had, I think, 5 companies under letter of intent, not 27. So that was a big lesson learned. You don't need to have 20 or 30 companies under LOI when you've got a good thesis. I think 5 is more than enough where you have visibility of capital deployment and there's a lot of fragmentation beyond that. So had those deals under letter of intent and then sought to raise more money, not because it was a different industry and they deserved more money, just felt like 25 million for the first deal was enough to raise. So went to 35 million, still below what we really needed. I think what we really needed for both of those was 50 to 70 million like we use today in most of our buy and builds or create and builds, but went out with that thesis. And then the other part of that story was going out and recruiting a platform level CEO. And at that time, we went out and recruited a gentleman named Don Devine, who's a West Point grad, served in the Army, and had worked at a number of other private equity firms running portfolio companies, including Sun Capital. Worked at Kelso and Littlejohn, and someone that I really respected. And by getting him to vet the thesis around pump repair, I think was a big feather in our cap by getting such a high quality seasoned CEO that had run much larger platforms, 50, $60 million EBITDA platforms, to come down market to underwrite this and build this platform with us. And that officially happened over the summer of 2016 and closed the first pump repair business in September of 16.
Was that Pump Man?
That's Pump Man.
And you did 16 acquisitions with that or add-ons?
We did, 15 or somewhere between 14 and 16 acquisitions for that one.
Okay.
Yep.
So in these first chapters, what are the things that you felt like you did really well? And then looking back, things that you would, do differently if you could give yourself advice?
Yeah, I think we did really well sticking to a relative value orientation, buying things for 5 to 6 times. I think we created a lot of value on the buy. I think we attracted a lot of LPs that valued that because so many private equity firms are just paying up increasingly fund after fund, paying sometimes 17 to 21 times for blue collar services businesses. I think that was really great. I think our businesses made sense. They were understandable. These are meat and potatoes, family owner operated businesses that people could understand. And I think there were a lot of opportunity and efficiencies to scale route density programs, procurement synergies, ability to take market share, cross-sell customers, figure out how to expand wallet share with better service offerings. I think those are all things that we did relatively well. There was probably some missed opportunities where we could have double clicked on things or did things to a better degree. But I would say things that were major lessons learned were around CapEx. We had one business in street sweeping that we did well on. We made over 3 times our money. We sold it to a global private equity firm. We had 28 IOIs when we went to market with it, but we had a strong CapEx program for the street sweeping trucks. They were about $250,000 at the time for a highway truck, and they were about $80,000 for a parking lot truck. If you add that up across our portfolio, it was quite expensive on an annual basis for the replacement cost for the ones that we needed to replace. And at the time, I think we figured that out after the fact. We didn't do a proper CapEx analysis on what we wanted end state and how maybe buyers would look at it from a free cash flow perspective. And so one of the things we do now in Fund 3 and go forward is we actually have a minimum criteria of EBITDA minus maintenance CapEx, divide that by EBITDA. That must be 90% or greater. Some of our businesses over the years have been challenged by free cash flow going to pay interest expense, especially as interest rates ran up, or just in general, funding their CapEx. And where we had interest rates going up, we were funding that and not able to maybe fund our CapEx program. It didn't allow us to go to market with new equipment in certain states. So I think that was a big lesson learned. I think another huge lesson learned for us is, we were young, we were immature, right? We did not have the process, the procedure, the stage gating, the after action review programs that we have today. I think what you guys are doing is wonderful with a lot of military backed people. We have someone on our team, Jeff Long, who's first in his class at West Point, was an Army Ranger, served for 10 years. He comes with a McKinsey background. He's put in a lot of process and procedure and after action programs so that we can review how we did well, how we can do better. One of the things that we didn't do well in the first sort of era of the firm, and I would say that's chapters kind of 1 through maybe 6, were thinking about our timing of ERP selection process and implementation of that ERP system and technology. We used to wait until the 3rd or 4th year right before we would sell. And then when we went to market, we wouldn't necessarily have every one of the acquisitions integrated into the business. And then certain buyers would deem this not a fully integrated platform. And maybe we would have to withdraw the process, or we would get dinged on multiple because it wasn't a uniformly integrated business. So what we do now is we actually, before we close, we select the ERP system. We have consultants that we use in addition to our growth and performance improvement team led by Jeff Long. And we are putting and implementing that system in place in the first couple of weeks when we buy a business. So it's a major change. I would say the other change is we used to generate 500 fresh ideas a year, new novel theses that hopefully no one else is going after. Some of those were good. Some of those were thought of 30 minutes before the meeting. So a major shift that we made in that was we now are generating about 1 a week across the team. We now have a template that has to be filled out by Friday at 5 p.m. Eastern and submitted so we can digest it well before the meeting so we can ask our articulate questions and everyone can challenge that fresh idea, what we call the deal champion. And in doing that, we're creating a much higher quality pool of ideas that we're sifting through per year. And of the 40 or so that we're creating per year, with those fresh idea templates, 30 get advanced to a qualification stage. We didn't have these different stages in the past. It was very much kind of finger in the air, and we were just moving so quickly. We were young and we were kind of running and gunning, and things happened good and bad. We didn't really take time to learn from those lessons, and we didn't have these stage gating programs that we have today with more maturity within the organization. And so when I think about the qualification stage, we're making a higher volume of calls now. We have an AI tool that is crawling the web and is scraping certain data that we couldn't have in the past with the advancement of technology. We're also market mapping. When I look at the companies in Fund 1 and Fund 2, we didn't carefully market map. We didn't look at GDP data. We didn't look at household income. We didn't look at weather data. We didn't look at density of trees. We didn't geolocate warehouse density. All that's happening now during our qualification stage. So we're not haphazardly like, oh, we're buying a roofing business in Las Vegas to start the platform. Why? Oh, because we got it under LOI first. We did that in the past. We're not doing that now. So that's I think the key parts of our evolution is graduating from sort of getting things under LOI, reacting to those things that we got under LOI that fit our criteria, not necessarily putting stock in where the geography was or
Yeah.
other data that'd be available to us.
This kind of reminds me of a quote, and I forget who said it. It might have been the garage door servicing business that Cortec owns. I think it's Tommy Menlo or something like
Oh yeah,
that.
A1 garage door.
Yeah. And I think he was the one who said in his podcast where he's like, the hustler had to die for the leader to be born. And it was this like, when you're starting a business as an entrepreneur, you have to do everything.
Yeah, you're
But
the
eventually,
owner operator, right? That's key. You own the business unless, I don't know, unless you've made enough where you can have a manager for you and then you're just clipping the coupon. But across this country, there are hundreds of thousands of those businesses that are owner operated, and some of those scale and they put in process and they hire and they build a team. But many of those continue to sort of have good years and bad years and stay in a certain zone, and that's the vast majority of them.
well, and it's so important, like the owner and the operator, like sometimes we forget that we're the owner and we have to do things that an owner needs to do. And that means sometimes stop operating and just work yourself out of these different functions.
Mm-hmm.
And that's what we're going through, going from 10 people to the next level of like, what are these? Fortunately, the account functions of the business are really doing well. And the greatest test of that was actually, the past 11 months when our infant twins were born on top of our 6 and 9 year old, like, well, we couldn't be there every single day, every single week. And my wife is also my business partner, co-CEO. And that was like a really good stress test of the account and execution functions. But it also exposed where we're weakest. And guess what? It was the front end on the sales where guess who's responsible for that? Me. And okay, I have to get systems and process for that function of the business. But it's so interesting that you think about, the evolution for your firm. When was it a particular person who joined the team who was like, all right, we're sitting down, we're going to go through all the functions. Jarrett, you're awesome at this. Stop doing that. Or how did you kind of evolve as an entrepreneur to, now today institutional fund three, but what were the different evolutions you went through?
Yeah, I think that's really important point because when you think about what you're doing and what I'm doing, I'm still running a business here, right? We've got a P&L, we've got rent. When I think about hiring people and growing the organization and continue to build out talent in a supportive, nurturing environment for people to build their careers, there's some things that I'm really good at, and there's other things that I'm mediocre in. And so I had to take stock in that, and I had to hire people around me that would help support me and make this organization the best that it could be. And I don't even have all the right answers to be able to assess would make this the best organization. I have to lean on other people that I respect and trust. And so when I think about the last 4 years, maybe 5 years, I've added more people to the team that I've known for a longer period of time, where I now have the money to hire the people that I wish I could have hired day one. They might cost 4 times as much as somebody that I had in the past, but I'm getting the ROI on them. And it's allowing me to pan out and market and measure the business in a better way that's better for our investors, and it's better for the management company, the firm, the people that work here. And so I give a lot of credit to Jonathan Tenenbaum, who sits behind those pictures and TV back there. I had worked with him at Sun Capital. He had gone on after business school to a couple other private equity firms. He's someone that I wish that I had recruited day one, but there was no hope of recruiting him to an entrepreneurial setup where I could have said, hey, why don't you join a private equity firm where we don't have any money, we don't have any investors, here's some Vistaprint business cards you can share with me, right? He's not somebody that would have come on and had said no at the time. But as I established this firm and built out this firm to a certain level, he saw a huge opportunity for him to come in and further professionalize it. So I think he, to his credit, brought a lot of best practices from other private equity firms, especially around process improvement, rigor, stage gating, and institutionalizing a lot of the things that were very much sort of seat of our pants, or sort of cowboy style when we were younger people, and then adding Jeff Long to a growth and performance improvement function, improving our margins, attacking market share, improving pricing, and working on procurement programs, safety, ERP selection process. We never had somebody like that in the past. Everybody that worked at the firm, most people hadn't even come from a private equity background, but had worked in some other white collar sales function. But nobody had come from an operator background, where Jeff has been the CEO of 10 companies, was at McKinsey for 12 years, and ran large scale businesses like PF Chang's, Penhall, the largest concrete cutting business in the country. And bringing Jeff and marrying Jonathan's experience along with Art and mine really enhanced the organization, and made this firm, this entity, much more sustainable.
So the business started in 2015, going through the pre-fund stage. And then in 2018, 3 years later, you closed the first institutional fund at 350.
Correct.
Right. And then walk us through that next chapter between 2018, Fund 2 at 350, and then where we're at today in February of 2026, you raised Fund 3 at 450. Like, talk about just like the evolution of the firm. And, that's also when the M&A, I mean, you've done 113 acquisitions. So maybe a key part of the story is just like, how did you successfully integrate these companies? And also, what are the things that you maybe kind of the fumbles along the way that you really learned just to improve the integration playbook?
Yeah. So we closed at the $350 million fund July 2018. We had 58 LPs total. We had LPs from Europe and the US, from public pensions, endowments, foundations, fund of funds, asset managers, high net worth individuals. And when I think about, going from there to the 450 fund and what happened in between, this was still the evolution of the firm. In Fund 2, we had 6 portfolio companies, did 40 total acquisitions of the 113, but we did not still during that fund do the market mapping. We still didn't have the process and procedure around fresh ideas. We didn't have that yet. We did not have an after action review program. We waited across that entire fund to implement the ERP system till year 3. We didn't have the Jeff Long functionality of growth and performance improvement. And we didn't have a 3-person IC as we have today to challenge each other the way that we do. And we didn't have sort of the quality and intensity around our investment team program, because we still couldn't afford it at that time after just closing that fund. And as we evolved as an organization, there was an opportunity for me to continue to enhance the people at the firm in 2021, which I did, and continue to build out the firm and backfill with better athletes, and continue to build out Soundcore the way that I had originally envisioned, now with more money at my disposal to hire the people that I wanted, and doing that on the heels of lessons learned, bringing in the highest quality private equity talent, having people with only the highest level of integrity and honesty at the firm, making sure we had someone to focus on growth and performance improvement, not waiting till year 3 to install the ERP system. Another thing that I think we were so wed to in Fund 1, where we did 45 acquisitions when we were a fundless sponsor, we, on average, I think it was 85% of the 45 acquisitions were below 1 million of EBITDA. And then you look at Fund 2, 85% were above a million of EBITDA, but still quite small. I think the average is like 1.9. When I look at those two pools and juxtapose them, I would say that it is incredibly difficult to take a $800,000 EBITDA business and grow that and double it to 1.6. And I would say, in comparison to taking a business that's doing 2 million of EBITDA and doubling it to 4, it's much easier to do that. So I think taking stock of those two pools and looking at them discreetly, I would say that when we thought about going to Fund 3, we really said, whether it's an add-on or it's the first business, we're really going to shy away unless it's a particular case of anything below $1 million of EBITDA. We're going to put that ERP system in place day one, essentially. We're going to have a very linear, thoughtful, objective program around growth and performance improvement. And we're going to dedicate to using outside consultants to help effectuate that change. And I think, as we have matured as an organization with more talented people, a bigger team than we have ever had, we had a year last year going into closing the fund this year, a few weeks ago, where we set up 3 platforms, which we have never done in a year before. The most we ever did was 2. We acquired 17 companies last year in doing that. That was an acquisition every 21 days. And we were able to do that because everybody at this firm is rowing in the same direction with a lot of guardrails around the setup, the maturity of the organization. It allowed us to move at a better velocity, a better pace, higher quality functionality. And that helps as an organization matures. And where we just hit our 11th birthday, we're still, relatively young. I'm still relatively young. I think I'm still below the median age when someone starts a private equity fund, even though I started it 11 years ago. Do we have all the right answers? No. We're always wanting to learn, always trying to hear, what other people find is working better. And I think this learning organization is better set up to do that today than we were maybe historically speaking.
I love it. What are some of the, if you were to give advice to someone kind of raising their first institutional fund, and what do you think matters the most in those first meetings with LPs? And also, what did you maybe incorrectly thought mattered, but LPs don't really care about? They just want to get to the other stuff.
Yeah, I think when I first started, I'll answer the second part first, that I just wanted to talk about, what we're going to do different, how we were hard charging at direct outreach to business owners. And we didn't really necessarily think about making it consumable to the LPs. We didn't come with IR backgrounds. I don't have an IR background, but I've had thousands of LP meetings at this point. So I have a better sense what maybe works and what doesn't. And depending on whether it's a family office or it's a public pension plan or it's a foundation or somebody else in between, I would say, if I was to give someone advice, the number one thing is show them that you're going to be a trusted partner. You have to be authentic in that, right? You can't sell them on that. So if you're not going to be a high integrity, honest person, you're going to have a lot of trouble raising capital and maintaining relationships with LPs. I would say beyond that first step, you need, especially in today's market, you need to have something that's differentiated. You need to have a better mousetrap than the other private equity firms. You can't go out and just say, I'm going to be the 100th healthcare service private equity firm, or I'm going to be the number 500th generalist lower middle market private equity firm, and I've worked with this buddy of mine at this firm, and we're going to start doing an HVAC deal or something like that, and we're going to be the 140th private equity firm to do that. That, if I'm an LP, I'm going to pass. Come with a differentiated program, marry that with high integrity, and I think you can then get to sort of the next sort of meeting with that LP. But you have to have an angle. Otherwise, why, if I'm an LP and I've got 1,000 firms to look at, why am I going to pause any more than this first meeting with you?
So maybe let's shift over to sellers. Out of all the meetings that you've had with sellers, what are the core things that you found that they care about when they're thinking about selling the business?
So we've acquired 113 businesses, as you mentioned. 96%, I think that's 109 of them, were directly from the founder or founders. These are typically people 56 to 65 years old. And I would tell you that, just like my father, who's now 73, they care about their legacy They care about the culture that they built, and they care about their people. Right? They want to make sure if they give control up of their business. So we're talking about control only private equity. It might be different if you're a private equity firm that's doing minority stakes and letting the business owner still own 70-80%. Maybe you have some negative control rights, but think about control only private equity. You need to give the confidence to that business owner that you are not going to strip it of its brand. You're not going to fire the local AR person that's worked there for 20 years, that's trusted them, that they said that they would never sell to anybody that would do that. Those are really, really critical soft skills but you have to be authentic about it. And you're not going to, tell someone it's something you're not going to do and then do it, right? But I think those are mission critical to that business owner. And then beyond that, if you're getting them to roll like we do, we've had an average seller roll of around 10.5% across 113 acquisitions. They're rolling into a holding company. You need to convince them that you're going to help them. Why are you going to be a good partner? You're going to help them grow. You're going to help them take market share. You're going to help them have better safety. You're going to minimize their attrition. But why are they going to roll into the holding company? Why do they care that you're buying this business, let's say in Nashville, and then you're buying, and they're going to continue to run the Nashville business under their name. They've rolled 10.5% of your holding company. The next business is in Charlotte. The next business is in Richmond. The next one's in Philadelphia. Why should they care about how those perform? So you really get them to buy into the network of these businesses under this holding company structure. And I think that can take a lot of time to build trust, usually in people that aren't the most trusting individuals. Because it's a leap of faith when you sell your business. It's a leap of faith when an LP commits to a fund. But when a business owner that's been running their own business, that's all they know in their whole life, they sell control to you. It's a huge leap of faith for them. And, I think building that relationship with them about how they, their rollover money is going to be treated, how are you going to treat their business, how are you going to treat their people? Those are, people to people in their, at their kitchen table kind of conversations.
In the first year, when friction points happen, what are those common friction points that sellers need to anticipate? And also what can be done just before a deal to help reduce the likelihood of those or the severity of them?
I would say one big friction point is private equity reporting. If you need daily KPIs, them understanding ahead of time that you're going to need that and what it is. I would say that, beyond that, sometimes you have private equity firms and, us in certain instances that want to put a uniform sales commission structure in place that we see working best at one location. And we want to have that uniformly adopt, maybe for good reason. But if you jam somebody with that without good explanation, without forewarning, that can cause a lot of friction. You might lose people, you have attrition, you lose customers perhaps. So I would say one of the things that we have developed over the years is sort of a welcome to camp playbook, handbook, if you will, that we give out during diligence so that can be thumbed through with the business owner and their wife or husband or brother or sister. And they can sort of see what's happening 2 weeks before close, what's happening the day of close, who's announcing it, how do their employees find out about it, what's happening to healthcare, 401k, what's happening 2 weeks afterwards, what's being implemented, why are you doing these things? Good communication early and often is a huge help in mitigating or reducing that kind of friction with that business owner.
Well, maybe changing gears a little bit over to annual meetings. How many annual meetings have you had? And can you just kind of walk us through the agenda? Like, do you start off with the night before it's a cocktail? Is it a walk through the office? Day two, is it in the morning? Then everyone's out by lunch, or do you do an event on day two afternoon? Like, how do you guys structure it? Let's just kind of start there.
Yeah. Again, I don't have the right, the license on the right answer, always trying to learn from other people. And we certainly ask our LPs, what do you see work well? What do you like? And then we'll collect that feedback to try to address that with our own annual meetings. I don't know. We've had 7 or 8 annual meetings or something like that at this point. We're having an annual meeting for our Fund 3 at the end of May. When I think about what we've done there, assessing the feedback from different investors, from college endowments to foundations to asset managers, et cetera, is we're doing a standing dinner, heavy pass hors d'oeuvres and cocktails. That way, no one's isolated to a table where they don't want to be, or sitting next to someone. Maybe they're talking to one person they like or one person that they don't like, and they can't sort of escape. And then you're maybe not getting flow of information and flow of meetings. So we're doing that in New York City at a historical venue, which we think would also be interesting. I think doing it in the windowless office in Kirkland's building probably wouldn't be exciting. Doing it on their 52nd conference room floor probably would be, but we're doing it downtown at a cool space that I think is going to be intriguing. People are coming in from multiple countries. We got LPs from, I think, 12 countries. And we've got them coming in from all those different places, as well as from the US. We want them to go somewhere that's going to be exciting. They're taking time away from work, their own dollars, away from their families. So we're doing.
I was at an AGM that was at like a World War II museum, and it was awesome. It was just different. It's not a windowless ballroom.
Yeah.
And it was super interesting to mix it up.
Exactly. Yeah. I mean, if I think of some of the AGMs that I went to when I was younger, and you've got 58-person tables, and you got a stage, and you got someone up at a podium, I have seen people fall asleep. We don't want to have that happen. So the night before, have high level of activity. We've partnered with Vijay Singh, the former #1 golfer in the world, who's won 3 majors, is playing in the Masters next week, wearing a Soundcore hat. He is an investor, regular way LP in Fund 3, along with another #1 in the world golfer who's a contemporary of his. And he's coming to the cocktail party, and I think that's a nice feature. He was the only person that was, I think, #1 at the time of the Tiger Woods core era, other than Tiger Woods. And so I think he's done a lot of exciting things in his life and represents a lot of the values and the hard work and integrity and stick-to-itiveness that Soundcore embodies. And so that's part of the reason that we partnered with Vijay. So he's coming.
Is he just an attendee, or does he have a speaking slot?
So for the cocktail dinner, he's going to be attendee and circulating in the room. And I think a lot of people are going to be coming up to try to introduce themselves to him. And we're very grateful he'll be there. The next morning, we're doing a long windowed building overlooking the New York Public Library and in Bryant Park, which we think is visually interesting. Again, it's not a closed room. We've had a lot of people talk about tables versus classroom style. And we've thought through that. A lot of people say do the round tables and have the GPs and people with their backs to the front of the room. We still think that you get kind of stuck at that table. So we're going to try it this year, doing short tables of like 4 or 5 people with their name tag. And we're going to have a lot of opportunities to get up. VJ and
classroom style.
Classroom style.
Yeah.
And we're expecting about, also in the context of our firm versus maybe a $10 billion private equity firm that has multiple funds that they're reviewing at their AGM. Yeah. They might have, 500 people in the room, and there's different challenges you have the bigger your firm is, the number of LPs you have. And we have, I think, 90 or so people that are attending. And then we have a few, virtual LPs that, can't make it. Maybe they've got some conflicts. Yeah. But we're having the day start off with some remarks, for me on sort of, macro that we're seeing in the world, challenges that we're having, opportunities that we see, themes that we like. And then I'll sit down for a Q&A with VJ, sort of, talk show style, right? And I'll be asking him some questions. And then what we're going to have is every one of our portfolio company CEOs sit down with a partner or principal on the investment team for that particular portfolio company. Also, talk show style, where they're having an active conversation. I've talked to a friend of mine.
So do you start off? Is it 8:00 when you start, or do you have like a breakfast there?
We're having the LPAC meeting the night before. Right before we're having the cocktail. Stand up a couple hours. So we get that out of the way. So that doesn't impact the morning, because even though we're not doing multiple funds, we're going to probably have about 5 hours of content, which is quite a
Yeah.
bit. And you don't want to get people to be yawning in the back of the room.
Yeah.
So
So
we're starting off with strong coffee at 8 a.m.
okay. Strong coffee, 8 a.m. And then you starting with state of the market, or do you also give firm update of like how do you
I'm
structure that
talking
part?
about macro things for the firm, some micro
Yeah.
things for the firm, and then I'm putting that in context with sort of state of the market, Soundcore in the context of PE, the global economy, AI, and then later on we're double clicking on some of those items with other speakers. So
Okay.
I'll be talking about those things. Then we do the sit down. Then we go through those one by one portfolio company CEOs. One of the benefits we had, and some of our LPs liked, so when we closed our fund, we were already 55% deployed on the fund. And
Yeah.
we already had 28 closed acquisitions and 5 portfolio companies. So we have 5 portfolio company CEOs. I think if we had 8 or 9 already in the fund, we wouldn't have all of them speak. I think that's too
Yeah.
much.
Now, do you how do you structure the order? Is it by fund, like here my fund two in alphabetical, or do you do everything by like, okay, we're going to start off with industrial services, then we're going to go to business services? How do you structure the portcos?
Yeah, so we're doing this meeting for our fund three. We have one remaining asset in our fund two, so we're not having an annual meeting for that just sole company. And so we had a letter that went out around that. So we're just
Yeah.
doing this for fund three going forward, and so we have them in sequential order of when it came into the fund. So portfolio
Of
company
investment date.
one, portfolio company two, etc.
Yeah. And then do you have slides popped up there that they're speaking to between the deal team and then the CEO, and you're just kind of walking through the story?
We'll have slides, but it's not like they're going to have a laser clicker and going through micro bits of data. It's going to
Yeah.
support the talk track, but it's going to be more organic conversation. The other thing that we're doing is you could say, hold your questions and comments to the end of the entire AGM. We're
Yeah.
letting the LP audience ask questions at the end of each called session.
And yeah, how have you done that in other AGMs, and how active has it been?
We've had typically, I would say, 8 to 12 questions. And what we did in the other AGMs so far is we waited to the end to answer those questions. And we think it would work better if we answer those questions directly at the end of each particular portfolio company. So we're trying that for the first time this year.
While it's fresh in front of mind, as opposed to 2 hours later, here's my question from the morning.
Exactly.
Yeah.
And people will forget what was said.
Yeah. Um, uh, do you guys use video in any of your AGM, or have you used it in the past?
Video in terms of the portfolio companies at work.
Yeah, like here's 60 seconds on what this company actually does.
We've talked about that. We will have pictures of what the company does in terms of sort of core service offering, and we've included those in other publications and other sort of general emails to our LP base. I think it would be great to bring them to life in maybe a 30-second video that was done in high
Yeah.
quality, but we haven't done that to date.
We did an AGM a month ago, so we video is core to what we do, but the AGM that we attended, just kind of being in the back as an attendee, one of the things I'm having been to a lot of these is like energy management. Because if you're doing the slide to slide to slide, you're like, and it's also the lights are at 75%
That's why
and
we need
it's
the
in the
coffee.
ballroom.
We need like an IV with a coffee drip.
What we found in this most recent one, where we managed the entire AGM, but also did the video portion of it. And it was just interesting to get these 60-second vignettes of, hey, by the way, here's what the company does. And I was asking the LPs, like, is this useful or not? And one LP said, like, you'd be surprised how much we forget what's actually in our portfolio. He's like, one guy said, he said, I go to 10 to 15 AGMs a year. And that's just me on the team. And so
Yeah.
it was interesting to remind them what the company does, not just when did you buy it, when are you selling it, how much we're going to get, but it just helped them to remember what they did. And
Yeah.
out of all the video, go ahead.
Yeah, I think that's something we should talk about further. Yeah, I mean, and you also have visual learners, right? They might be able to read that margins are this and revenue's grown by this, and they can kind of conceptualize it. But I think
Yeah.
seeing the business go to work in in a customer setting, I think is valuable for most people.
Yeah. And there are certain videos that you need and don't need, like, team updates doesn't really do as much, but really on the portfolio, because you're going to have the rest of the team that is going to be there. And then you can just also use that stuff for the website, and also the porcos can use it. But I found it was interesting to interrupt in a positive way the energy. So it's like a reset before I go to the next porco. Then it's a reset before I go to the next porco, because you have music and everything. So on AGMs, is there anything that you did in the past you're like, all right, clearly not going to do that again?
I mean, I think we did 1 year for COVID. We did 100% virtual, and I really don't want to go back to that. I think it's really important to meet people in person and really encourage your investors, to come in person if they can manage with their schedule.
Yeah.
I think investing in a private equity fund is like a mini marriage, and I think it's important to see your counterpart. In addition to you going and visiting them, on a not all the time, but on a fairly regular basis to maintain that and build that relationship and that level of trust that's really important in a relationship. I think it's great to have people there in person. I think the story comes to life much better in person. I think you have better conversations that way.
Yeah. Cool. Last question is, when's your next marathon?
So I've run 5 marathons. I took a little bit of a break to start deadlifting and do a 5x5 program, if you're familiar with that.
No, what is that?
That's core sort of Olympic lifts where you're bench pressing, you're doing deadlift, you're doing squat, you're doing bent over row, you're doing shoulder press, and you have an AB program. So week 1 would be ABA, next week would be BAB. And what you do is you add 5 pounds every time you go back to do your next squat or your next deadlift. And it's incredible how that works. I started off deadlifting, I had never played football in high school, so I was never taught to deadlift properly. I had to watch in a YouTube video. Started off deadlifting, I don't know, maybe 135 pounds just to get it right. Yeah. And doing that program, I got up to over 400 pounds deadlifting. And it was just a nice gradual increase. It's how your muscles train to get larger. And it's like a foolproof way to build muscle and strength. So I did that for a while, which was really not conducive to running marathons because your body wants to shred all that extra muscle. And so, I'm not doing the 5x5 program anymore because I'm not training to be, Mr. America or something like that. So I'm thinking about running another marathon again. One of the things that we do is the JP Morgan Corporate Challenge every year as a team, which is only like a 5K in Central Park. We've done that for, 4 or 5 years now. Jonathan Tenenbaum, who I mentioned earlier, again, across the wall from me, he just got back from, I think, his 4th half marathon of the year. So at some point I'm planning to run one again, but my next sort of challenge is I want to do a 50-mile run. I always felt like I had more gas in the tank at the end of a marathon, and could go a bit further. And so I want to try a 50-mile, flat run.
That's awesome. Well, in June, for the 3rd year in a row, we're having the 51 Labs Charity Endurance Challenge, which is a modified Goggins challenge, where you have 5 options. You can do 51 miles in 51 hours. So every 4 hours, you do 4 miles, and then you cap it off to get 51. You can do 51 miles in 1 day. You can do 51 miles in 1 week.
51 miles in 24 hours being 1 day.
Yep. So 51 miles 1 day, or spread out over 51 hours to kind of give you a little there. That's challenge 2. Challenge 3 is 51 miles in a week. Do a little bit in the morning, a little bit in the afternoon, a little bit at night. Challenge 4 is
that I know I can go out and do right now, the 51 in a week.
Well, then you can't do that if you know you can do it. So we've done the past.
I used to run in my training sometimes 50 to 70 miles in a week. So I know that.
That's easy for you then.
Yeah.
Okay. And then the 4th one is 112 miles on the bike if people prefer biking, or if people want to swim, they can do 10,000 meters in a week. We've had people do rowing, Zumba, it doesn't matter. We raised $5,000 per team. We had 10 teams. And so we raised money for 51 vets and then Chris Nickich Foundation, the Kyle Peace Foundation. So that is in June for anybody who is interested. I know Gridiron's going to have a team, and there are a bunch of others that are having a team. And I had.
All right, well, you're creating some competitive juices over here for us. Let me.
I know you're not competitive at all. At all. I'm just throwing this out there. So awesome. Well, hey, it is so cool to have this discussion. We can double click on a whole bunch of these topics, and we're going to have a part two, and it'd be awesome to connect with Jeff.
Jeff Long, yeah.
Especially given his background at West Point with military. Thank you so much for doing this. Really appreciate you coming on.
Absolutely my pleasure, Jordan. Thanks very much.